Hello, and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you accelerate your dreams. Today, host Pamela Ritchie is joined by Fidelity Director of ETF and Alternative Strategy, Étienne Joncas-Bouchard, to discuss the record-breaking ETF inflows this year, shifting trends in asset allocation, and innovation in the Canadian ETF space. Étienne highlights the evolving role of thematic ETFs, spotlighting their appeal in targeting emerging sectors like clean energy and technology. Additionally, he shares insights on how investors are leveraging ETFs for diversification and cost efficiency in a volatile market. With a keen focus on market trends and strategic ETF solutions, Étienne offers a comprehensive look at how investors can adapt to today's dynamic landscape. This podcast was recorded on December 6th, 2024.
Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. ETFs have had a truly record year. The latest data from Morningstar Research reports that investors have poured record sums into exchange-traded funds through the year, well surpassing the annual flows record, which was set back in 2021. And our next guest notes that for the first time in 3 years, equities are outselling fixed income. Joining me now for a discussion on the latest flows and trends in the ETF space, including an update on the Fidelity All-in-One ETFs, is Fidelity Director of ETFs and Alternative Strategy, Étienne Joncas-Bouchard. Welcome. Great to see you.
Thank you. It's great to be back.
Yeah, super to have you join us here, Étienne. Let's just sort of dig into a little bit of the year that was, and just a couple of top reasons why it was actually quite different to other years in terms of what people have been buying within the space.
For sure. Like you mentioned, I think this year has been exceptional, without a doubt. It's a testament, one, to a vehicle that's been adopted more broadly among investors, advisors, institutional players as well. The ETF industry has shown no signs of slowing down this year, and it's really been a constant growth rate that we've seen over the past years. But once again, we're still seeing acceleration in that growth rate, albeit the Canadian ETF industry has been around for the better part of 25 years. It doesn't seem like we're in the 8th or 9th inning right now at all. It feels more like we're right in the middle of the ball game. You mentioned equities outselling fixed income. That's definitely one of the highlights, I think, this year. There's more of a risk-on appetite that we're seeing. I was looking at the top 10, or I guess I should say 11, because 11 is the one I want to mention. But two of the top 11 ETFs with outflows this year are actually cash alternatives. So you're seeing
that's going to be an interest rate story. Yeah.
Yeah, no, absolutely, right? So you're seeing, where is that going? And it's a natural behavior that when, risk markets are doing well, equities are doing well, bonds have had an okay year. I think we're pretty much lining up for the yields on a product. We're not getting that much capital gains right now as rates and yields have moved around throughout the year, but you have seen a shift back to equities. So out of that $65 billion that I mentioned coming into the industry, we're right around $36 billion into equities, another $21 billion into fixed income, and then 5 to 7 being split up across the various other groups. But you look across the board, and it's all green, right? And there's very few exceptions that are in the red, if you will, in terms of flows.
It's been an exciting year. It's also been the sort of year where you just want to get out of the way of that train of momentum. And I wonder if we can dig into that a little bit. Actually, there's a slide that might go with this conversation. I'll let you call for it. But if you can just sort of speak to, essentially, you didn't want to get in the way of that.
No, for sure. I mean, what worked last year has seemingly continued to work this year, but we have seen a broadening of the market, and that doesn't necessarily mean that what's worked in the past is not working. It just means that there's other things that are starting to play catch up, and you've seen that by the performance, say, of an equal weighted type index. You've also seen that with the performance of small caps now kind of catching up, right? So there's a broader set of opportunities that are working at the same time, which is, generally speaking, good for investors, right? Unless you're very focused and very concentrated in the way that you invest, you tend to benefit by having this type of approach. And it also benefits factor investing, where we're searching for fundamentals and not so much just what's the biggest stock, what's working so well right now. We're more looking at what's giving us an attractive investment profile based on these fundamental characteristics, whether that be momentum, which is technically a fundamental characteristic, as much as valuation, as much as earnings, as much as volatility profile of various stocks. But yes, momentum has been good, but it's not necessarily coming from the exact areas that we think it would. I mean, yes, tech is the best performing sector in the S&P 500, But like I mentioned, there's other areas as well. So actually, we could pull up.
Which slide do you want to pull up there? There's actually a couple we can go to.
Yeah, sure. I mean, well, if we're on the topic of momentum, we can bring up our first slide, which highlights our U.S. momentum ETF, which is one of the core building blocks in our all-in-one ETFs, which I'm sure we'll get a chance to touch on later. But if we look at here, what we're seeing is the year-to-date attribution of this mandate as of December 2nd relative to the S&P 500. And in fact, it's the utilities sector that is pulling performance. And it's not because it's one of the best performing sectors, but there have been some names that have done exceptionally well in that sector, two that I've noted on this slide, being Vistra Corp and Constellation Energy. They're very small parts of the S&P 500, but have had outsized returns this year. But due to our factor methodology, which includes earnings revisions, includes going away from short interest stocks with high short interest, also includes 12-1 performance, other metrics that would dictate momentum. Selected these stocks, back in earlier in the year. So some really solid performers in other sectors, albeit, like I said, tech is still leading the way, and it's still the largest sector in the S&P 500 by far.
So there's a couple of specific stocks in there and companies, obviously, but the broader story for utilities has to do with AI, data centers. This is the story, right?
Yeah, it could be that the first leg was, okay, who's making the chips and who's going to win in that area. The second part is, well, to get those chips working, you need a lot of power, right? So utilities comes into there. I think there's a double pronged story there too. It is a rate sensitive sector, so when you have a rate hiking cycle like we saw back in 2022, yes, those are companies that generally have higher leverage and they have lower or less flexibility on margins. They require more capital to generate a dollar of revenues. But as rates come down, you're getting a more attractive investment space, if you will, for that. And that includes sectors like REITs, and includes sectors maybe that are more defensive in nature, right, and higher yielding. So as we've seen central banks get a bit more dovish, if you will, this year, or at least following along the guidelines that they've provided where rates should naturally come down as inflation does, some of these sectors are bouncing back. So yes, you have the AI part, which is non-negligible, but you do definitely have kind of that macro component being favorable for those kind of higher yielding defensive sectors as well.
Now, when I introduced you, you have a slightly actually different title than when we spoke to you last. And I wouldn't mind asking you just to kind of go through what you're overseeing at this point. I mean, you got a little bit of everything and you're telling us about it, but what does it mean, particularly sort of as the offerings ultimately expand?
Yeah, I mean, it's like we mentioned the ETF industry in Canada in general having this boom. We're feeling it here at Fidelity, and I'm happy to say, and I'll brag a little bit, we're punching above our weight right now. And I think that comes with a team that's expanding. Many of you that are listening in right now have probably had the chance to hear some of my colleagues, Vince and Raghav, who are ETF strategists on our team, speak. My new role now is to lead that team, but then also to expand it, right, as our assets grow, and to better serve our advisor clientele, to provide more insights on our various products. I mean, our lineup continues to grow. There's also the alts component, which is another major driver of growth here at Fidelity, but also just in the investment or asset management space, I should say. So that's, I'd say a large chunk is focusing on our ETF strategy team and alt strategy team, but demand and I think a need to have somebody dedicated to providing insights on attribution for those portfolios, as well as just covering that lineup a bit more. So part of that new role that I'm in now is that of an IPM, if you will, for the all-in-ones. So,
okay,
yeah,
institutional side of things. That's amazing. Well, I mean, we could crack open that one because we're going to talk about that anyway. Let's. I wouldn't mind just first getting a sense of what you've seen in the last month or so. I think you have some recent data. I mean, it is end of month. We're getting jobs, so both sides of the board. We're getting lots of things that are showing what November has meant ultimately. And it was a big investing month. So many different things and moving parts in it. What can you update us on just there for the month of November?
With regards to the all-in-ones, or just more broadly speaking?
No, more broadly speaking. And then we'll
yeah. No, absolutely. I mean, this is also, and I'm not at all trying to get into politics here. It's not an expertise of mine. It's not something we tend to focus on, right? We're more focusing on, the stocks we're selecting through our quant processes and so forth. But there has been definitely, positive momentum that's been generated post-U.S. election. One of the main themes that I mentioned earlier was broadening, right? So you've seen small caps kind of join in on the fun. You've also seen, crypto assets carry some of the load as well. We saw Bitcoin hit over 100,000 more recently. You've had rallies in other alternative coins as well. Once again, not necessarily an area of expertise for me, but that's something that's non-negligible. You've also, this just, I guess, maybe to do an asterisk with regards to Bitcoin, we saw this morning, as reported by Bloomberg, spot Bitcoin ETFs in the US are now the large, if you aggregate them together, the largest holders of Bitcoin in the world. So in a matter of less than a year, they hold more Bitcoin as a group than anyone else. So that's definitely
let's take that and just jump into the all-in-ones with the Bitcoin piece, because it's always been a sliver and there's a lot more going on in the all-in-ones. But just as sort of a touch point, what has it contributed ultimately to the performance that we've seen there? And then we'll...
Sure, absolutely. Actually, we can pull up slide 3, which is a look through on our all-in-one balanced ETF, which, for all intents and purposes, kind of our main mandate, if you will, especially among the advisor community. It's a 60-40 balanced portfolio. Core exposure on the equity side is our U.S. factors, Canadian factors, international factor ETFs. 12 of them on that side. We've got a couple fixed income mandates, as can be seen here under the tickers FCCB and FCGB. And then we have a little bit of Bitcoin, a little bit of small cap that is actively managed. But what I've done on this slide is just to show where we currently are from a positioning standpoint relative to our base neutral mix. And just as a reminder, once again, to our audience, these are not portfolios that have active asset allocation. We're not making calls from an asset allocation perspective as much as a geographic perspective or even from a factor perspective, right? So we have these neutral mixes, and they deviate over time based on performance, as well as inflows and outflows into the portfolio. And the reason why I say inflows and outflows is, if something's underperforming and we're largely underweight relative to our neutral mix, well, that's where the net new dollars are going to be going into the portfolio. That's how they're going to be invested. So once again, to get back to this slide, basically what you can see is, if we look at the 4 bars to the left, those are our 4 US factor ETFs. Those are overweight right now.
You got over on the right.
Yes, no, on the right. Let's address that one. For sure.
Big one.
Bitcoin in our all-in-one balanced ETF, the target neutral allocation is 2%, right? So right now we're at 3.1%. That's coming off of Bitcoin that's up more than 130% so far this year. And as you can see, we're not 130% overweight, right? Because we're not actually going out and purchasing net new dollars of Bitcoin as the assets go up, because it is currently already overweight in the portfolio. The one thing I need to emphasize and want to emphasize is, because we do get the question often, right, is because we are fairly unique in the sense that we're the only managed solution in Canada that incorporates Bitcoin as we speak into the neutral mix. But if we strip it out, the rest of the components are also adding value to the tune of about 1.2% net of fees. So I think it's definitely helping, but it's not necessarily there also just for the simple fact that we want to capture the upside or the potential upside of Bitcoin. The reasoning behind it is for added diversification. It's for benefiting from an alternative asset class, contributing to different risk return streams than traditional bonds and equities.
So let's ask you about it being an alternative and a diversifier, because there are lots of different ways that people take that. At times it has acted like growth. At times it has acted more like a diversifier. Just tell us what the latest look of it is and how you get to that point of it being a diversifier.
Yeah, the longer we look, the better diversification effect it tends to have. Because yes, to your point, it's been kind of like a levered tech feel to it, right? That's pretty much what it's felt like the last couple of years. It hasn't always been the case though. So right now, the way that, yes, it has had a higher correlation, but so have other asset classes as well. Like if we go back to 2022, correlations were very positive across various asset classes. So we take a longer time horizon. We tend to look at it as something that's different, that has different supply and demand economics, if you will, than traditional bonds and equities. And it's something that's being more and more, I think, looked at as something that is here to stay, right? If we look at just the verbatim that we're hearing from, upcoming, I guess, if you will, U.S. government, I mean, there seems to be more openness to incorporating Bitcoin into, or regulating it to a higher degree, where it becomes, I think, a more widely held asset class. So it's a combination of multiple things, but from our perspective, it is meaningfully contributing to risk-adjusted returns.
speaking about what's in the funds as well, there's been a broad discussion this year. I mean, the Canadian stock market's done pretty well, but you get the whole sort of currency discussion and the U.S. exceptionalism discussion in there. How does that get expressed, whatever the views are there, in some of the ETFs?
With regards to currency?
Not necessarily currency, but sort of the U.S. equities exceptionalism, which you pointed to.
Yeah,
earlier.
yes. No, sorry. Yeah, no, absolutely.
Versus Canada, basically. Yeah.
Yeah, no, absolutely. So the way that we've constructed, once again, like these portfolios, we're not trying to tactically overweight the U.S. because we have stronger views on that market. Albeit, I know as a firm, we have been more constructive on the U.S. economy and the U.S. market relative to, say, developed international or even Canadian markets. For us, it's we looked at it as what makes sense from a neutral mix. We also looked at what's out there, like what is our competitive landscape and how are they positioned. So not to say that it's not relevant, but it's not a call we're making, right? It's kind of our neutral asset mix where if we look at our equity component, 50% is US, 25% Canada, 25% international developed. And it's going to stay that way. Right, but it does deviate because of performance. So right now we are technically overweight US, but that's simply based off of the performance. And once we rebalance at the end of January, we will be going back to that kind of neutral 50%. How
often do you rebalance?
So the portfolios themselves are rebalanced like a full, let's call it a full rebalance once a year. It's for a few reasons, obviously from an efficiency standpoint, it does make sense. Secondly, we are constantly rebalancing the portfolio, like I was mentioning earlier, with inflows and outflows. And third is if you rebalance too frequently, and this is a lesson that we can learn also from the underlying factor sleeves, which them are being rebalanced at different frequencies, which, if you take our US value ETF, for example, it's rebalanced semi-annually. If you look at our US momentum ETF, which is also part of one of the components, it's being rebalanced quarterly. So the underlying, if you will, the high level portfolio is being rebalanced once a year, but the underlyings are actually significantly more active in the way that they're changing their holdings. So there's kind of the two-step process there.
If we get into a couple of sectors, we talked about utilities and you showed us that earlier, but take us through some of the Canadian things that we depend on, energy, materials, also financials as well. It's been a big week for reporting. Financials.
Yeah, cyclicals, I guess maybe if I just take a quick step back, our kind of outlook or perspectives, if you will, for this year, and this was echoed by, our head of quantitative index solutions, Bobby Barnes, as well as kind of the main message, core message, if you will, from our team was that we were in a late cycle environment for the year. Now it's kind of up for grabs, especially in the US, is like, are we kind of navigating back to a mid-cycle? We have broadening markets. Like that's not typical necessarily of a late cycle environment, but all that to say is, late cycle was kind of the base case. From a macro standpoint, it definitely does say that if we look at PMIs and so forth. And the reason I say that is because that's usually an area, a time where late cycle factors work, and late cycle factors generally don't have a lot of weight to cyclicals, right? So they're generally not overweight energy, financials, materials. And if we look at some of those sectors, it has been more of a challenging environment this year. Financials is a bit of a standalone, right? I think there's a few things for that, especially in the US. US financials have done really well. I think the possibility of less restrictive policy is something that comes into play. You've also have, a consumer, a consumer that's doing fairly well. I think maybe once again, not so much the case for Canada. But, I think obviously the Canadian banks are kind of very different in the way that they operate. I can't speak particularly to any of the names, but it has been a sector that's done fairly well.
Yeah, no, it's fascinating how this all comes together. Let's talk a little bit about bonds, because I think we did at the beginning, mostly noting that it was part of the flows story. It was part of where money was coming out of and going into. That said, it's also arguably a great diversifier. Bring us up to date a little bit on how that's working.
Yeah, bonds haven't done what everybody was expecting. And not to say that, once again, like I mentioned earlier, I think it's been a fairly decent year for fixed income markets. But the call coming out of 2022 was that duration might be time to add duration. And I think even last year and this year, it's just been more of the same. Credit spreads have continued to come down. Being short duration has been a winning trade once again. And now you've seen kind of like this bear steepening to a certain extent. I know yields have slowly started to come down more recently, but like if we go back to say September, you actually saw the short end start to fall as rate cuts were expected to come from the Fed. But then you saw longer yields come up where you look at like a U.S. aggregate bond index. That wasn't an ideal scenario where you're seeing kind of the long end rally. So for us, it's actually been great because the way that, say, if we look at our all-in-one ETFs, our main core allocation in that portfolio, our systematic Canadian bond ETF, the strategy is actually to reconstruct the Canadian Universe Bond Index by having a larger allocation to short credit and less allocations to long credit, and then favoring maybe more the kind of the long end is being favored on the governmental side or the federal side, notably, and provincials. So it's actually been a really good year for us on a relative basis with our product lineup. But once again, it's been kind of a challenging environment to navigate because you've had the appetite to add duration. It just hasn't quite paid off yet, right? So we'll see what comes next. I think maybe there's an argument to be. Sorry, go ahead.
Yeah, duration is well, it's just so tied to inflation, isn't it? And there seems to be a little bit of a question mark there. But we'll see. You'll tell us what's right as we go along.
Yeah. No, I mean, I think. I'd be more comfortable with duration in the Canadian context than a U.S. content. We saw just unemployment numbers this morning. Once again, Canada
not looking so great.
No, it's a tough environment, and I think we look just at the differential in GDP growth, GDP per capita, leverage. I mean, there is a lot of signs pointing at a slowdown in Canada. I can't really say the same for the U.S. right? So I think it's to be definitely something to keep an eye out as a portfolio manager, as an investor. There might be a time to add duration. It's just we've pushed that kind of back further, a lot further than what we would have initially anticipated.
It's a great question here that I'm sure you get asked a lot, and I'm dying to hear your thoughts. Yeah. So how many of the ETFs in the lineup are also available as mutual funds?
I won't be able to give you an exact number, but a big portion. The all-in-one ETFs are available, via mutual funds, and I think those are kind of our core now multi-asset strategies. Some of our factors are available also, like our dividend factors, our quality factor, low vol. We also have all of our active ETFs, which is something we haven't really touched on much here, right? Obviously, because kind of our focus on the quant side, but all of our active ETFs are a series of existing mutual funds, right? So that's kind of we did the opposite. We had the fund, we launched an ETF series, which in the past our team's been more we'll launch an ETF and then offer a version in a fund structure that can then buy units of the ETF. But I'd say a large part of our lineup, and I guess the one thing I'd say for more information, just obviously reach out to your Fidelity sales team or go on our website, fidelity.ca.
Tell us a little bit more about the small caps, because we went into that. You mentioned the actively managed sleeve, and we've had the opportunity to speak with Connor and Chris over the course of many months. But this was the classic story of sort of the macro markets, of the broadening story, and when will it hit small caps? Well, it did hit small caps.
Yeah.
Hit in the summer, then they kind of laid off a little bit, and then it came back to bear when the rate story got going, the cuts.
Yeah.
Take us through what that's meant ultimately as the fund itself, but also it's within the all-in-one.
Well, I definitely can't speak as well to the fund as Connor and Chris can, but we're very happy to have them as part of our all-in-one ETF. There's no doubt. I mean, the what they've done with their portfolio is outstanding, and you can look at, yes, broadly small caps have started to pick up some steam, but they've done an exceptional job in managing their mandate. And small caps is very fascinating to me because it's an area where strong active managers have shown real strength, right? You can see that it's a huge investment universe. There's a lot of lower quality stocks, and I'm not saying that from a qualitative standpoint, like judging on their business practices and things like. I'm literally just judging on like earnings quality and your average return on equity. There's some great companies also, but there's a lot of companies that are not as quite strong investment profiles from our perspective. So having the active component in the small cap space is crucial. If you look at an index like the Russell 2000, which is often used as a U.S. small cap benchmark for the U.S., there's a record amount relative to large caps in terms of unprofitable names. Large caps in the U.S., there's a record low amount of companies that are unprofitable, and small caps were closer to record highs. And it's not because there's necessarily been a wave of like challenges and things like that. It's an environment that's grown and grown and grown. Lower cost of capital has allowed a lot of these companies to stay around. But being able to filter through that with the help of active management has been a really, really good strategy over the past couple of years, and will benefit from just the macro tailwinds that small caps in general are experiencing also. We're just getting expertise with it.
What's sort of a final point to maybe punctuate this year that was, and going forward? What would you like to say to that?
I mean, it's been a record year all around, as much for the industry.
Exhausted. Need a break?
Yeah, I mean, no. We're always ready to roll. It's been a record year, as much from an industry standpoint as from a Fidelity standpoint. And I think we're almost at year end, and I guess it's more time to. And U.S. Thanksgiving we just passed, so I guess I'm very thankful. I'm very thankful for all the support from the advisor community. A lot of people that are listening in right now have contributed to that, and we're very happy with the solutions and the products that we've offered to market and the performance that we've seen, and we're very excited for next year as we continually try to improve the products, but then also provide new solutions to the market. We're gonna have more ETFs on the shelf. We're gonna have more alts on the shelf, and it's exciting times.
Good. We look forward to hearing some of those announcements. Étienne Joncas-Bouchard, thank you for joining us here today.
Pleasure. Thank you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. And while visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.